Management Theory and Practice. Controlling Function of Management. Introduction. After studying this chapter, you will be able to explain the basic steps in the control process, understand the types of control, use and importance, describe effective control systems, explain budgeting, understand ratio analysis, describe PERT and CPM. Control is one of the important functions of management. The main object of control is to bring to light the variations between the standards set and performance, and then to take necessary steps to prevent the occurrence of such variations in future. It is the process through which managers assure that actual activities conform to planned activities. The first step in the control process is to establish standards against which results can be measured. The standards the managers desire to obtain in each key area should be defined as far as possible in quantitative terms. Standards need to be flexible in order to adapt to changing conditions. Every objective, every goal of the many planning programmed, every policy, every procedure and every budget becomes a standard against which actual performance might be measured. Controlling function of management. Establishing standards, physical standards, such as labor hours per unit of output, units of production per machine, hour, and so on. Cost standards, such as direct and indirect cost per unit produced, material cost per unit, selling cost per unit of sale, etc. Revenue standards, such as average sale per customer, sales per capita in a given market area, etc. Capital standards, such as the rate of return on capital invested, ratio of current assets to current liabilities, etc. Intangible standards, such as competence of managers and employees, success of a public relation program, etc. Controlling function of management. Measuring and comparing actual results against standards. The second step in the control process is to measure the performance and compare it with the predetermined standards. Measurement of performance can be done by personal observation, as in the case of the subordinates being observed while they are engaged in work, and by a study of various summaries of figures, reports, charts and statements. If the control system is well organized, quick comparison of these figures with the standard figures is quite possible. One important point to be considered before introducing a control system is whether measurement and comparison are to be done at various stages in the total process or at the end. If the purpose of control is to catch trouble while it is forming, then this should be done at various strategic points before the end of the process. Controlling function of management. Taking corrective action. Corrective action should be taken without wasting time so that the normal position can be restored. The manager should also determine the correct causes for deviation. The causes for deviation may be of different types, such as inadequate and poor equipment and machinery, inadequate communication system, lack of motivation of subordinates, defective system of training and selection of personnel, defective system of remuneration, etc. The remedial action that should be taken depends on the nature of causes for variation. Need for control. Measure progress. In the planning process, the fundamental goals and objectives of the organization and the methods for attaining them are established. The control process measures progress towards goals. As the navigator continually takes readings to ascertain whether he is relative to a planned course, so does the manager take readings to see where his enterprise or department is on the charted and predetermined course. Need for control. To uncover deviations. A successful control process is one that effects corrections to the organization before the deviations become serious. Change. It is an integral part of almost any organization's environment. Markets shift, new products emerge, new materials are discovered, and new regulations are passed. The control function enables managers to detect changes that are affecting their organization's products or services. Complexity. Diversified product lines need to be watched closely to ensure that quality and profitability are being maintained. Sales in different retail outlets need to be recovered accurately and analyzed. The organization's various markets, foreign and domestic, require close monitoring. Mistakes. Managers and their subordinates very often commit mistakes. A control system enables managers to catch these mistakes before they become serious. Delegation. When managers delegate authority to subordinates, their responsibility to their own superiors is not reduced. The only way managers can determine if their subordinates are accomplishing the tasks that have been delegated to them is by implementing a system of control. Types of control methods. Past-oriented controls. These are also known as post-action controls and measure results after the process. They examine what has happened in a particular period in the past. Such controls are most accounting records, inspection of goods and services, and school grade reports. These controls can be used to plan future behavior in the light of past errors or successes. Future-oriented controls. These are also known as steering controls or feed-forward controls and are designed to measure results during the process so that action can be taken before the job is done or the period is over. They serve as warning posts principally to direct attention rather than to evaluate. Future-oriented controls are, however, particularly important because the information feedback in them is at the input side of the system. Essentials of effective control system. Suitable. The control system should be appropriate to the nature and needs of the activity. Controls used in the sales department will be different from those used in finance and personnel. Timely and forward-looking. The control system should be such as to enable the subordinates to inform their superiors expeditiously about the threatened deviations and failures. The feedback system should be as short and quick as possible. Objectives and comprehensible. Objective controls specify the expected results in clear and definite terms and leave little room for argument by the employees. They avoid red tape and provide employees with direct access to any additional information which they may need to perform their task. Flexible. The control system should be flexible so that it can be adjusted to suit the needs of any change in the environment. Economical. Economy is another requirement of every control system. The benefit derived from a control system should be more than the cost involved in implementing it. In the early days of the mail order business, the money in incoming orders was not counted. Prescriptive and operational. The system should be prescriptive and operational. It must disclose where failures are occurring, who is responsible for them, and what should be done about them. It must focus more on action than on information. Acceptable to organization members. The system should be acceptable to organization members. When standards are set unilaterally by upper-level managers, there is a danger that employees will regard those standards as unreasonable or unrealistic. Reveal exceptions at strategic points. A control system should be such as to reveal exceptions at strategic points. Small exceptions in certain areas have greater significance than larger deviations in other areas. Motivate people to high performance. A control system is most effective when it motivates people to high performance. Since most people respond to a challenge, successfully meeting a tough standard may well provide a greater sense of accomplishment than meeting an easy standard. Should not lead to less attention to other aspects. Control over one phase of operations should not lead to less attention to other aspects. If controls put pressure on employees to increase output, the quality of work, care of equipment, and prevention of waste should not be neglected. Problems in the control process. Magnitude of change. Control systems are mostly designed to cope with changes of a certain magnitude. Certain decisions are made regarding which of the variables in the system can change, how much they will change, and what actions can be taken to connect these changes. The system is designed around these variables. It provides for alternative labor sources and for maintenance men or production engineers who can be called when technical problems occur. These corrective actions are programmed into the foreman's decision rules. The variables have gone outside the range that the control system was designed to handle. It may be cheaper to accept an occasional production stoppage rather than pay the cost of designing and operating a control system that can be adapted to all potential variations. Problems in the control process. Time rate of change. Time lags in feedback can cause severe problems. Such time lags tend to slow down the adaptive process, that is, they increase the length of time it takes for the control system to respond. Organizational control systems, particularly at higher levels in the organization, often depend on written reports for their sensed information and on written memos or directives as the corrective feedback. Information overload. Information overload is another problem in a control system. If managers at all levels receive identical detail about any event, they may be overburdened and may neglect their immediate responsibilities. Management Information System (MIS) is an organized method by which managers at all levels in the organization are presented with needed information in the right form and at the right time so that they are in a position to perform their tasks well. Computerized MIS, which has now become a normal feature, though eminently suited for structured or programmed decision, is not suited for strategic decisions at the top level. Problems in the control process. Erroneous standards. The most critical problem in a control system is that of some inadvertent mistake being committed in setting standards for comparison. The decision maker is not certain whether the deviation message being received is a result of the activity being out of control or the standards being improperly set. The Quality Control Department sets the standards for accepting and rejecting units off an assembly line. The decision maker may not find the problem until he investigates what is happening in his apparently out of control system. Problems in the control process. Workers' resistance. Failure to accept objectives. If a person fails to accept certain objectives, he may find the control mechanism that pushes him towards those objectives a distinct annoyance. Unreasonable standards. A person may dislike control because he thinks the standard of performance set for him is too high. Too many controls. Too many controls act as irritants, but there is no simple rule to warn a manager as to which additional control is going to prove as the last straw on the camel's back. Inaccurate measurements. Sometimes people dislike controls because they believe that the measurement of their performance is inaccurate and consequently they do not get credit for the work they do. Short time span of appraisal. Sometimes people complain that the time span of appraisal is too short to enable a fair assessment of their performance. Disclosure of unpleasant facts. Many people do not like controls because they fear exposure of their weaknesses before their peers and subordinates. There is also the fear of an unfavorable report leading to demotion, cut in pay, reprimand or dismissal. Wrong persons trying to control. Senior people dislike controls when they come from their juniors in the management hierarchy. Thus, a line person may not like being controlled by a staff person and may say, "Who does he think he is?" Opposite social pressure. People pay greater regard to the performance norms prescribed by their groups than to the formal standards set by the manager. Control techniques, types of budgets. Sales budgets. It is a comprehensive sales programmer and plan for developing sales. It lays down the sales potential in terms of quantity, value, period, product, etc. Sales forecasting is the basis for preparing this budget. Selling and distribution cost budget. This budget lays down the cost of selling and distribution of the product during the budget period. It includes advertising cost, research and development cost, transport cost, etc. Production budget. This budget is based on the sales budget. It lays down the quantity of units to be produced during the budget period. The main purpose of this budget is to maintain an optimum balance between sales production and inventory position of the firm. Production cost budget. This budget is based on the production budget. It lays down the estimated cost of carrying out production plans. Capital expenditure budget. This budget outlines specifically capital expenditures for plant, machinery, equipment, inventories and other items. It also points out the plans concerning investment, expansion, growth, improvements, replacements, etc. Cash budget. It indicates the requirement of cash at various points of time and helps the management in planning and arranging cash to meet the needs of the business concern. Cash budget helps the management in controlling and coordinating the activities which involve receipt and payment of cash. Master budget. A master budget gives a summary of all the functional budgets and shows how they affect the business as a whole. In other words, it is compiled from various subsidiary or functional budgets. It provides detailed particulars regarding production, sales, cash, fixed assets, etc. Control techniques. Advantages of budgetary control. The different functional budgets clearly indicate the limits for expenses and also the results to be achieved in a given period. This helps the enterprise in eliminating uncertainties and in having a planned approach for its various activities. Budgets make it possible to coordinate the work of the entire organization in devising budgets. Managers take into account information provided by the sub-units of their organization. Since budgets are generally prepared with the consultation of managers at different levels, they provide to the enterprise the fruit of combined wisdom. Lower level managers are motivated in accepting and meeting budgets that they have had a hand in shaping. The budgetary control brings together the activities of various departments in an overall perspective, and this promotes cooperation and team spirit among the employees. Through budgetary control, the deviations from the predetermined standards are found out and the management is enabled to take suitable corrective action immediately. This minimizes wastage and losses. The budget system helps people learn from past experience. Once the budget period is over, managers can analyze what occurred, isolate errors and their causes, and take steps to avoid those errors in the next budget period. Budgets improve communication. A plan cannot be put into effect unless it is communicated to those who must carry it out. In the process of developing the budget with those responsible for its implementation, managers can communicate their own objectives and plans most effectively. Control techniques. Limitations of budgetary controls. Budgets are mostly inflexible and rigid and do not respond to internal or external environmental changes. Insofar as they are in error, because of these unmanageable changes, they lose their validity as a standard. Budgets are of little help in handling the here and now problems that supervisors have. They are useful only in analyzing the past and charting the future. In a budgetary control programmer, people show anxiety to spend their current budget to the hilt so that their budget for the next financial year is not reduced. They show little concern to evaluate the result of their spending. Performance in the budget-based organization means the ability to maintain or increase one's budget. A good manager is discouraged from taking initiative and undertaking activities for which provision has not been made in the budget, even though they are useful for the enterprise. Control techniques. Standard costing. The cost of production determines the profit earned by an enterprise. Standard costing is one of the techniques of cost control, and it is being increasingly used by modern business concerns for the purpose of cost reduction and cost control. The objective of standard costing is the same as that of budgetary control. Setting of cost standards for various components of cost such as raw materials, labor and overheads. The standards fix the limits within which the different types of expenses must be kept. Measurement of actual performance. Comparison of actual cost with the standard cost laid down. Finding the variance of actual cost from the standard cost. Finding the causes of variance. Taking necessary action to prevent the occurrence of variance in future. Control techniques. Responsibility accounting. Responsibility accounting can be defined as a system of accounting under which each departmental head is made responsible for the performance of his department. A department generates profits by selling its output to other departments or profit centers in the same organization. The prices at which one profit center sells its output or services to other profit centers are called transfer prices. Control techniques. Financial statements and ratio analysis. The trading profit and loss account and the balance sheet of a company are the usual financial statements which are prepared ex post in retrospect to indicate what financial events occurred since the last statements. Depending on the company, the period covered by a financial statement could be the previous year, the previous quarter, or the previous month. Managers can also use these statements to compare their organizations with other organizations and can thus evaluate their own performance. Ratio analysis seeks to extract information from a financial statement in a way that will allow an organization's financial performance or condition to be evaluated. It involves selecting two significant figures from a financial statement and expressing their relationship in terms of a percentage or ratio. Liquidity ratios. They measure the company's ability to pay back short-term debts by converting assets quickly into cash. In other words, they are a measure of a company's liquidity. One such ratio is the current ratio. It is expressed by the fraction current assets plus current liabilities. Debt ratios. While liquidity ratios are used to measure a company's short-term financial position, debt ratios are computed to assess its ability to meet long-term commitments. The simplest debt ratio is total debt divided by total assets. This ratio tells us what proportion of the company's assets is owned by its creditors. Profitability ratios. These ratios express profits as percentages of sales or of total assets to depict the company's efficiency of operation. A profit of INR 4 lakh, for example, is unimpressive if it is derived from total sales of INR 40 crore or a capital investment of INR 100 crore. Operating ratios. These ratios measure how efficiently the manufacturing and sales are being carried out. Some of the more common operating ratios are the inventory turnover ratio and the total assets turnover ratio. The inventory turnover ratio is defined as sales plus inventory. Control techniques. Return on investment. One particular approach to financial control that has received considerable attention in recent years is the return on investment ratio, ROI, also known as the DuPont system of financial analysis. It is expressed by the following formula. This ratio is computed on the basis of capital turnover, sales plus investment, multiplied by earnings as a proportion of sales, profit plus sales. This calculation recognizes that one division with a high capital turnover and a lower percentage of earnings to sales may be more profitable in terms of returns on investment than another with a high percentage of profits to sales but with low capital turnover. New control techniques, PERT and CPM. PERT was first developed for the US Navy in connection with the Polaris weapons system and is credited with reducing the completion time of the programmer by 2 years. CPM was developed jointly by DuPont and Remington Rand of USA in order to facilitate the control of large, complex industrial projects. Both PERT and CPM are primarily oriented towards achieving better managerial control of time spent in completing a project. Under both the techniques, a project is decomposed into activities and then all activities are integrated in a highly logical sequence to find the shortest time required to complete the entire project. The use of both PERT and CPM has spread rapidly today in controlling time-critical projects such as reinforcing a weak dam, constructing a building at an Olympic site, or completing contracts that include penalty payment clauses. New control techniques, human resources accounting. Human assets in an organization are no less important than its material assets. Human resources accounting refers to the method of reflecting the rupee value of the human assets in the company's balance sheet. Personnel are superior to the other with regard to such variables as the following: level of intelligence and aptitudes, level of training, level of performance goals and motivation, quality of leadership, quality of communication upward, downward and lateral, quality of decision making, quality of control process, capacity to achieve effective coordination, valuation at cost. Under this method, the employees of an organization are evaluated on the basis of the cost which the organization has incurred in selecting and training them. It should be noted that under the traditional accounting system, This cost is treated as revenue expenditure and is charged to the profit and loss account. Valuation at economic cost. Under the first method, the human asset is shown in the balance sheet at its historical cost, which is not enough if the balance sheet is to serve as a health chart of the organization. Valuation at replacement cost. Employees can also be valued at their replacement cost, that is, the amount which will be needed to replace them completely. It should be noted that it is always impossible to replace the present personnel by a new set of people and still have the same organization. Summary. Control is a very important process through which managers ensure that actual activities conform to planned activities. It involves 3 basic steps: establishment of standards, measurement and comparison of results against standards, and taking corrective action. A control system is needed for 3 purposes: to measure progress, to uncover deviations, and to indicate corrective action. Most control methods are grouped into 2 basic categories: steering controls, which detect performance deviations before a given operation is completed, and post-action controls, in which past experience is applied to future operations. For a control system to be effective, it must be suitable, forward-looking, objective, flexible, economical, perspective, acceptable, motivating, and focused on strategic control points. A control system fails if the magnitude of change which forms the basis of control far exceeds the anticipated amount. There is a communication barrier. There is time lag in feedback. There has been some mistake in setting the standards. There is resistance from the employees.